Hello and welcome to the Outlook by CAP STRAT, featuring a special sneak preview of our next deep dive topic, how we use various data points to attempt to predict the presidential election. First, we'll start with the Fed and their dual mandate. We've talked a lot early in the year about the inflation side of that mandate. But what changed in June is the labor market, the employment picture becoming much more important to both the Fed and the markets. So Mike, let's take a look here at the beverage curve and what we see happening within the labor market.
In our view, Mary Daly, the San Francisco Fed president, delivered a key speech in late June where she brought back the beverage curve. Just as a reminder, this is an academic construct that basically shows there's a relationship between the job vacancy rate, which is just job openings versus the number of people in the labor force, versus the unemployment rate. And so the Fed is trying to bring down job openings in order to help defeat wage inflation and prevent a wage price spiral. And in doing that, they run the risk of accidentally going too far and increasing the unemployment rate. Mary Daly brought this back up. A couple things that she said were notable. One, she believes we are now at the point where job openings have declined so much that any further decline in job openings or any further loosening in the labor market would beget an increase in the unemployment rate, likely beyond the SOM recession signal, which is a key signal that says if unemployment rate increases too quickly, too much, too fast, then the economy tips into a recession. So in her view, they've made all this progress. The Fed has made all this progress on loosening the labor market. Any further progress could result in a recession. So they need to start thinking about this side of their dual mandate. That's key because, that idea had pretty much been ignored since March 2022. You got sort of this free lunch where you can bring down job openings without increasing the unemployment rate at all. So that was key, that very notable that she came out and said that in a speech. The other thing she referenced was the 1970s, but in a much different way than the 1970s had been referenced by other Fed members previously. She spoke to, yes, the inflation was bad, but the joblessness was just as bad, which is debatable. But nonetheless, she said it. So we think that's key for a number of reasons. The Fed is clearly thinking about the labor market. If they're going to start justifying interest rate cuts, this is how they do it. You bring in fancy curves that nobody understands, right? And you say the other side of their mandate is potentially at risk, so now we need to justify rate cuts in an election year.
And that's the employment picture approaching this point of chunky increases in the unemployment rate is even if you just take all the jobs numbers at face value, right? And something we talked about in detail in the first edition of the deep dive was why that may not be a good idea. So what's happening here between non-farm payrolls in the dark blue and then the light blue bars, which is the household survey?
The non-farm payrolls report, the establishment survey, what's happening is everything's perfectly fine. And then if you look at the household survey, everything is not fine. Actually, these are recessionary type conditions. This is 6-month moving average of monthly jobs added or lost. One says, hey, we're already in a recession, Fed, why aren't you cutting? The other says, hey, everything's just fine. And that's why the June FOMC meeting minutes were so key, because they spoke to this. The FOMC understands this divergence. They're starting to come to the realization or get on board with the idea that this is more representative of the true underlying strength or lack thereof of the labor market, because the dark blue bars are potentially inflated by immigration, which they can't count on going forward. We agree with that, given that tighter immigration policy is becoming a bipartisan issue, and also the job openings aren't there to continue to attract immigration at the levels we've seen over the past few years. And then the other reason is these dark blue bars are going to get revised down. A preliminary estimate of those revisions is going to come out in August before the September Fed meeting. And those suggest that the jobs gains as recently as Q1 of this year could be much lower than previously stated. So the Fed's taking these dark blue bars with a grain of salt. They think the labor market is potentially much more fragile than the monthly non-farm payrolls report would lead you to believe.
Yeah, and so all of a sudden, that's the tough side of the dual mandate, right? Is this employment picture is getting a little more bleak and approaching a point where we could see a notable drop-off. But the part of the mandate we've been focusing on for all this time has gotten much more benign, right? Inflation is kind of okay right now. What are we seeing here from a breadth and temporal mix of inflation?
Let's look at breadth first. You take each of the components in the core PCE basket, and you measure the percentage of them that are running over 4% on a 6-month annualized basis. So they're all going down, right? All those lines are pretty much going down. Then you look at the temporal mix. What do we mean by that? Well, some items in the basket are leading. When there's going to be a big pickup in inflation, this is where you're going to see it first. Car prices, think that. Then there's coincident. They give you no temporal lead or lag. And then there's the lagging components. Those are the things where the prices go up with a lag, usually because of the increases in the leading. So if car prices going up is leading, car insurance rates going up are lagging. The temporal mix, if you look, the hot areas in the inflation basket are all pretty much lagging, which to us suggests, that's pretty benign. That's exactly what you want to see if you're looking for inflation to continue to come down. We look at this and say, this combined with the labor market data and say, if the Fed is worried about a resurgence and a re-acceleration of the inflation data from here, where's it going to come from? Where's it going to come from? There's no smoking gun. It's not clearly in the data.
Absolutely. And so you take these ideas, the unemployment side, the inflation side of the dual mandate, and we start to look at handicapping both what the market thinks and what we think the Fed may do for the remainder of 2024 here. We talked about inflation, mid-low 2s on a 3-month and 6-month basis based on our forecasts for the remainder of the year. And now all of a sudden it's like late 23, early 24, and we're looking at a 0.75% chance of a cut at the September Fed meeting. So Mike, what needs to happen between now and then, or how do we see this playing out?
The inflation is sort of a yellow light. We're not all the way to 2%, but it looks like we're getting there. So then if you're going to cut rates, you have to justify it with the other side of the mandate, which is why we put out the speeches in the academic papers, the Fed does this, talking about how the labor market is rebalancing. So you can tell they're trying to justify a rate cut. Let the record state, we think they should have started cutting in June and maybe even followed through and cut again in July, but they talked themselves out of it. And so now there's been a lot of discussion, and we've thought about this plenty as well. Why would you, the Fed, start a rate cutting cycle at the meeting before the presidential election? The reality there is you're damned if you do, you're damned if you don't. A lot more literature has come out suggesting the Fed in election years just sticks to the model. That's the only way to justify what you're doing. And like we showed in the last Outlook video, they're not sticking to the model. The model suggests they should have started cutting already, and instead of having 2 cuts this year, they should do 4 cuts this year if they're sticking to the inertial Taylor rule model that we think they should. So they're behind. They're only behind by a little bit. Thankfully, the normalization in the labor market, we think, is going to get them to sort of get on board with cuts in September. We think that's a good thing. If they wait too long, they don't go in September, the labor market deteriorates further, we run the risk of a recession.
And of course, that would be the Fed's primary concern, right? Leaving rates too high for too long, bringing the economy into a recession. And so checking in on our recession signal, still not active, but seeing a lot more yellow than we've seen here lately, both in the real economy signal, across all 3 of those factors getting close to their trigger points, and then within the labor market signal, initial jobless claims rising as well. Again, not active, but potential for this to become even more concerning as we go.
Exactly. And if this were to trigger, then we would immediately flip from a bumpy landing to a hard landing. That's a whole new set of rules. That's a very different video shoot.
Yeah, absolutely it is. So let's take this to the markets a little bit, checking in on earnings and expectations. And what we're looking at here, we've got the Mag 7 and the other 493, right? The haves and the have-nots we've talked about. And maybe seeing a little bit of convergence here from an earnings perspective. What's happening here?
Yeah, heading into earnings season, the consensus is that we've seen the peak in Mag 7 year-over-year earnings growth. And that's primarily because the year-over-year comps are getting really hard, and you have the law of large numbers. And that earnings growth should decelerate from here sequentially. Decelerate to what? 53.5%. That's still all right. But at the same time, you see the other 493, the consensus here is that earnings have troughed and that they're going to start picking up again to something, 4.2%. So that's one big thing we're watching. The other thing we're watching is overall expectations for S&P 500 companies are about as high as they've been since late 2021. So the bar is high, and usually before earnings come out, that bar gets lowered through estimate revisions. It hasn't been revised down that much. So the bar is relatively high, and a lot of these Magnificent Seven companies like we spoke to are very expensive. The expectations are really high. The only way to justify their valuations is if they deliver on these earnings expectations. So the risk there, in our view, coming into earnings is a bit asymmetric. Typically that means if they match or beat, they'll get rewarded, but if they miss, they'll get punished potentially much more asymmetrically. So this, once again, we talked about how prices suggest we should have a rotation. Fed rate cuts are potentially the catalyst, and now the fundamentals are starting to suggest on the margin there should be a rotation. The hope is that the market structure is stable enough to handle that rotation in an orderly fashion without a technical correction or something worse. The concern is that this has gone on for too long. And we won't have an orderly rotation.
And one of the biggest impediments to that orderly rotation is this historical all-time high equity concentration we're seeing. S&P 500, over a third of that index is in the top 10 holdings. Russell 1000, nearly 3/5 of that index is in the top 10 holdings. This is pretty crazy, frankly. But it speaks to the potential for a disorderly rotation. If you're seeing all of this concentration in these 10 names and they start to disappoint on earnings, that could get potentially ugly. All right, and then we'll wrap up with a preview of the coming deep dive video looking at the presidential election. Apparently people want to talk about this and hear what we have to say and how it might impact markets and portfolios. But Mike, give us just a little preview.
Just a tease.
How do we think about predicting the next president and how it should impact portfolios?
We use 6 metrics to try to predict the outcome. The key is we want to see them all lining up in one direction and feel confident in that outcome in order to start preparing portfolios for that outcome. If not, then we're basically looking to prepare for anything, just prepare portfolios for any outcome. At this point in the game, most of them are Republican or leaning Republican. We'll talk through them in much more detail during the deep dive. The only one that's leaning Democrat is Alan Lichtman's keys to the White House, which at this point, a lot of the keys to the White House are still up in the air. So a lot can change there. So if we were to just look at current momentum that the Republicans have post-debate, it's looking like a lot of these could be leaning or firmly Republican by the time we get towards the second debate. But we'll see what plays out. And then in that deep dive, we're also going to tackle what are the key policies that could be implemented based on these different outcomes of who's in the White House and then how Congress is divided or not. And then finally, what are the market implications for things like currencies, bonds, equities, areas of the equity market, et cetera. So a lot more to unpack there.
Yeah, absolutely. So tune in next week for the deep dive to hear more about our process around the presidential election. And that'll do it for this edition of The Outlook. If you have any questions or comments, please feel free to reach out.